Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Bulls and bears continue to battle it out, but this weekend, look to the Eagles to rule the roost. Fly, Eagles, fly. This week, our three things are: 1. Where is the recession? The answer lies in the uniqueness of this cycle. 2. Lender sentiment. Banks and markets have diverged. And 3. Stability. It's returned to risk markets. All right, let's dig a bit deeper. So where is the recession? The Fed and other central banks have slammed shockingly hard on the part of the inflation equation they can directly control, namely excess demand, by hiking interest rates to an extent few thought possible a year ago. The idea is to curtail borrowing and spending, which in turn would pressure corporate earnings and loosen up the jobs market. Instead, we got positive 3% real GDP growth in the second half of 2022 and a 53-year low in the unemployment rate. Inflation is coming down predictably, and wage pressure is moderating. Risk premia in stocks and credit are lower than long-term averages, much less embodying cash flow weakness suggesting recession. So what gives? Some, including Goldman Sachs and Alan Blinder, the latter, the former vice chair at the Fed and current professor at Princeton, believe a recession can be avoided. Mr. Blinder this past week penned a comment in the Wall Street Journal saying inflation is falling fast, worthy of a pause in the hiking. After all, Mr. Blinder opines, the Fed's job is to reduce inflation, not to drive the economy into the ground. Those positions imply that there is enough economic fuel to power the economy into a soft landing, to more than offset the drag of a rapid rise in interest rates. Turns out that economic fuel has been there throughout, in the form of excess cash sitting on the balance sheets of both consumers and businesses. Excess savings on consumer balance sheets we estimate to be around $1 trillion. Corporates are carrying an estimated $190 billion in cash, about $30 billion above trendline. These stockpiles, now dwindling steadily, have softened the economy's landing over the past 6 months or so. It's safe to say that as these cushions dissipate in 2023, the prospect for a harder landing increases. Given the fact that the hard data has turned negative in things like housing, retail sales, and industrial production, and given the view that the Fed is not likely to pivot until it completes the inflation-taming job, we have no inclination to declare victory just yet. Extraordinary stimulus continues to fuel economic growth. Just be prepared for when that falls away later this year. All right, on to our second thing, creditor sentiment. Financial conditions, the overall level of financial stress in the U.S. money, bond, and equity markets are improving, so much so that the markets are concerned that that is a reason the Fed must continue to tighten. Measures of financial conditions, however, miss signals sent by another important pool of lenders, the banks, and sentiment among that group is far less bullish. Loan underwriting standards across corporate, consumer, and both residential and commercial real estate tightened sharply in the 3 months ended January 31st, according to the Federal Reserve's most recent quarterly survey of senior loan officers. The net percentage of banks tightening commercial and industrial loan standards for large and medium-sized firms was 45%, a figure we haven't seen since the second quarter of 2020. Same story for lending to small firms, where net tightening was a similarly outsized 44%. No surprise on the commercial real estate side, where construction loans, commercial mortgages, multifamily loans all saw significantly more stringent lending standards. And the same story on consumer lending, where both credit card and auto lenders saw their most discerning risk appetite among lenders since the height of the pandemic. So how does this compare to the market's view? Now, if you plot tightness of lending standards against high-yield spreads, you get a rather tight correlation as you would expect. But interestingly, over the past 6 months, the two have diverged, spreads grinding lower, while the percentage of banks tightening has moved higher. Which will blink? Well, if we had to guess, we would watch out for widening credit spreads. All right, on to our third thing, the return of stability. At least for now, one of the hallmarks of 2022's year to forget, volatility, has stayed for the most part on the sidelines in 2023. The Chicago Board of Options Exchange Volatility Index, you know it better as the VIX or the fear gauge, had fallen steadily from October's recent high of 34 back down to 18 before bouncing this week back up to a still relatively constructive 21. We would attribute that move to the expected ending of the Fed's tightening cycle, increased prospects of a, let's call it, softer landing, and corporate earnings growth coming in largely as expected. Similarly, the ICE B of A Move Index, which measures Treasury volatility, has also come down from its October high of 161, which was at or near its 13-year high, back down to 102. And for credit, the settling down of the risk-free rate in particular has been critical for markets to function efficiently. The previous year, with its GFC level of Treasury volatility, graphically illustrated how challenging it was for investors and issuers alike to size and price deals, even high-quality deals. The new year has brought with it stability in the Treasury market and good visibility in risk markets. What a difference a year makes. Now about that irrational exuberance. So there you have it. 3 things in credit. 1, where is the recession? Stimulus has delayed it, but it's coming. 2, lender sentiment. Banks have grown more cautious. Investors should as well. And 3, stability. It's returned, and it forms a constructive backdrop for risk assets. As always, thanks for joining us. Don't forget to check in on kbra.com for our latest research and ratings reports. Fly, Eagles, fly. See you next week.